Hey, this is Sasha Evdokov, and welcome to another episode of Let's Talk Stocks, where we talk about the market, give you some insight, and just give you some ideas for trading. Now, in today's episode of Let's Talk Stocks, we are on episode 71, and we will be talking about the volatile market. So that's the name of the game. That's what we'll be looking at, evaluating. We'll be looking right at the charts. I'm going to take a look at some of the popular companies as well, and that way give you some insight on what's going on underneath and how the charts are moving, reacting, and behaving. Okay, so if we take a look at the S&P 500, which is one of the indices that I really love trading, and it's one of the indices that a lot of big investors also look at. And this indice right here, if you've been with me for quite some time, you know and understand what's going on underneath and what we've been talking about over the last month, and just the different things I've been talking about. We discussed that we were moving sideways for quite a while, and I said that if we break certain levels, we were talking about this 2000 level in the past, that things could get nasty, real nasty. And here, as you see unfolding, or things unfolding over the last month and a half here, or the last month, things have been getting fairly nasty, at least according to the news, according to what's going on and what's happening. And, you know, in part, they say this is due to economy, this is due to oil prices. In reality, it doesn't matter what the core reason is, because there's multiple reasons that impact the market. There's multiple things that affect the market. It's not one specific individual thing. But looking at the overall pattern, for those of you that are my, let's say, intermediate to advanced traders, or people that have been with me for some time, you'll slowly start seeing this A to B, B to C, C to D pattern forming. So does that mean, what is my prediction basically off of this A to B, B to C, C to D pattern? Because we haven't finished the C to D, and you don't know the pattern until it's fully complete. But this is how stocks move. This is how they move and behave. So for me, what I'm looking at is that potentially for the small term, meaning small term here over the next month or two, these stocks are nibbling and touching this level of support that we're discussing here at 1810, 1815. Those are the key support levels. 1812 really is the base. And if we drag this S&P line all the way over, you'll notice the lows in October of 2014 is right around 1820. So that's a critical line of support, and we've basically broken that a little bit. We're touching with it, we're playing with it. And what happens is similar to how stocks don't go straight up, they pull back and retrace. The same thing here in today's markets, in this month's markets. They're not going to go straight down. You'll notice here, if we delete some of these lines and we look at the trend from January 2016 all the way to the mid-January here of 2016, you'll see that we went straight down, but we didn't go in a perfect straight line. I mean, there was a few little pops that we had, a few green bars, such as on the January 11th, January 12th, we had some green bars that popped. But then really what we had was a slight retracement, which was our B to C leg right there. The B to C leg was right here for about 10, 12 days starting on January 20th. So that was our rebound. Then again, we took it lower. And if we look at the spiders, which we can see the volume here, you can see that the volume to the upside, or the volume that was strong, was to the downside right here. From January to mid-January, January 19th, we had strong bearish volume. Then when we retraced, that volume died down. In fact, you can have it look at like a C-shaped pattern from January 19th to about February 1st. There's like a C-shaped pattern. And then once we continue to break lower, the bearish volume started to again increase. And then you had the chats with Yellen. Now, I'll give you some insight about Yellen and all these chats, these big chats, when these big guys or the big boys start talking. Then what you want to do is just hold off on your positions, because it can really throw a lot more volatility into the markets. Now, today, what happened was that we basically, if we look at the day action, I'm going to give you some rundowns. There's some key levels I was watching, especially during the chats and things like that. So I'm looking at this low on, what was it? January 20th. I'm looking at these lows that we had right around the 181 or the 1812 level, and we came back to test those levels. We bounced off of that. Now, they said, the news said, whoever said, it doesn't matter who said it, they said that this was due to the OPEC meetings, that they are thinking about production cuts. Now, imagine this coming out exactly where this support line is. Do you think that was planned? Think about that for a minute. Do you think there's some, well, I'm not going to say conspiracy theory. What I'm going to say is, do you think that this somehow was planned potentially to stabilize things? You know, most of the people that are doing the trading, the investing, a lot of these major players, they have insider knowledge. And you say that they don't. You say that, you know, everybody's playing fair. The reality is they will manipulate these markets. They will manipulate these markets. Take my word for it. And what they'll do is they'll bounce it. They'll bounce it. They'll spike it. They'll see if they'll get any new buyers coming in. They'll see if they get any retail traders. And then the retail traders are saying, this is the bottom. Could we see the bottom? Oil prices are bouncing. And a lot of people get sucked into these positions, unfortunately, especially if you're new. You say, well, this is a great place to buy. And then later, a few days later, things continue to roll over. And unfortunately, for me personally, I've been burned way too many times on these kinds of trades where I'm trying to fish and catch a bottom. So a lot of times what happens is they'll hover, they'll spike around this region or area. And then what they'll do is they'll see when the buyers are drying up, and then they'll break it lower. Now, I'm not saying we can't do another B2C retracement like we did from January 19th, 20th, all the way for 13, 14 days. And we had a nice huge run. If you look on the S&P, we had a nice run of about 126 points, this B2C pattern. But I mean, that's still 126 points relative to the overall move of 268. And if we look at a Fibonacci level from the swing point right here, I'm just going to share some insight with you guys here. Look at how beautifully that comes into the swing point. So what I've done is I've drew the swing point from December 29th, 2015 highs all the way to January 20th lows. I drew my Fibonacci levels right here. And then the Fibonacci level goes to what? 50%. At the 1950 S&P level. Imagine that. How does that line up perfectly? And if you look at it right here, this comes back up to it as well. These on January 12th, we have it testing. January 13th, we have it testing. But more importantly, this February 1st, we had it testing. And what happens at the beginning and end of the month? Window dressing. They rotate positions to show the investors, the people that are not watching the stock market, hey, we got these positions. Hey, we got those positions. So they needed to change the positions at the end of the month. And then after the first of the month, what happens? They continue rolling it back over. Boom. I hope the light bulb right now is going off. Do you understand what's going on right here? Look at this. Look at February 1st. Okay, we're doing position rotations. We're coming into the end of the month. January 28th, we go higher. January 29th, we go higher. We need to show something for our investors. January 29th, we're going higher. Again, in those 3 days, we had a pop of 58 points on the S&P. Now, February 1st, we start rotating out of positions. It's almost even territory. Then again, February 1st, still rotating. Then February 2nd, we're pulling it down. Okay, February 3rd, we continue to pull it down. Look at the fib level, how it comes right into 50%. Remember what I say about 50% to the upside. A retracement of 50%, if you're doing an A to B, B to C, C to D patterns such as this, a pullback to 50% means the stock is still fine and healthy. Now, what happens if you do it on the downside? Because that's what we did on the downside. That means it's a healthy pullback, a normal pullback. That means that right now, especially if we break this 1810 level, you're going to see that floor and that rug being ripped out. And you heard me talking about this market that things could get nasty. I talked about it before. Now we're looking for bottom buyers. We're looking for bottom fishers, value buyers. So what could happen right now, this is where the dangerous territory lies. If you're too early and you get in too early here at the 1809, 1808, because you're trying to get in too early, you're trying to short the stocks, you're trying to get in too early, you could get burned, because what they might end up doing is they might go to about 1800 and give you another 30 points to the downside and then bounce and whipsaw right back up violently, because there's so many people shorts. There's so many short people on the position, and me including. We will cover very quickly if things start reversing, because you're just taking your profits. You're saying, I don't want to lose my profits. I'm out. So what they'll do is they'll start buying those shares back, and that'll run those stocks back higher. And it could get it back up, 1950 level on the S&P. And then again, you could have a second round of selling. But, that really just depends what's going to happen tomorrow. But some of these things, what happens is they will isolate there for a few days. So what you may get is similar to what we did over here on September 28th and 29th. We had a slight little bounce. Then the next day we actually bounced. So you may get a slight little bounce, over the next day or two. But if it just hangs out there for a little while, because what stocks can do is they can hang out. What they'll do is they'll hang out for a little while. Let's take a look at this region or area of August in the 2015. So look at what happened here. What they'll do is they'll hang out for a little while. They'll hang out for a little while, and then energy builds, and then they break lower. But they're hanging out at this support level. Okay, we can take any stock. The same thing happens on these stocks. It doesn't matter what company you talk about. Pick a company and you'll notice that they hang out, especially the big companies. Same with Apple. As we get into January here of 2016, stock is heading lower. We know it's heading lower. Then it'll bounce. It's trying to hang out and find the retail buyers, trying to find these bottom fishers. Then it reverses on Tuesday, the next day, January 5th. Then it continues to move lower, January 6th. So that's what happens. And now look what's happening with Apple right now. The lows of this crazy fast August 24th flash crash low is now being tested. We're hanging out. And the longer they hang out in that area, the more likely it is to break. If it keeps pushing lower, think of it like a jackhammer, or think of it like a hammer, a tool, keeps pounding on that roof. The more it keeps pounding on that roof, eventually it's going to break through. So the same on the reverse. If it's pounding and pushing to the upside, the more likely it is to power higher to the upside. But in this case, we're pounding down, but it could be building a base. So you want to always watch it and wait for the true break. Now, we talked about Tesla. I even tweeted about this one. I was short in this stock. It's one of the reasons why I don't trade earnings, because you see what happens is that these things reverse. The earnings were horrible. The earnings were not very good. And but the estimates or the projections, they seemed fairly optimistic. So what does that do to the stock? Well, first it sells it off. Then it continues to power it higher after hours. Now, today, it continues with its regular momentum. So could have been short covering. It could have been. But this is why I don't trade earnings, is that we were watching this critical line of support in what level? 180. And a lot of members asked me about this, and you ride that stock down all the way for 20, 30 points. I mean, how many of you would love to get 20 or 30 points in a stock? You ride it down. And if you look at this hourly right here, you can see here the A to B, B to C, C to D. Now, normally I don't really look at this, but you see it evolving right there. Instead, the bigger picture right here on the daily, you can see it's a nice, solid, clean. It's a very clean support line. If you look at the weekly, that line is crystal clear. So you get in it when it breaks. Boom, you're in, and that's it. If you look at trip, we had the same exact thing. Okay, so if we take a look at this weekly clean line of support breaking, now it popped due to earnings, and this is one of the reasons I don't trade earnings. I get out, and but you can see it reversing. So when you look at all these stocks, it doesn't matter if it's Amazon and so forth. What you're doing is you're looking at the pattern, and here's our A to B, B to C, C to D. And if I take the Fibonacci level, let me just take this Fibonacci level on Amazon here, you can see, let's just see how it plays out. Oh, look at that. Let me reduce the volume. Look at how that plays out. We get up to the 38.2% line. Our spike was at the 61.8% line, right around the 640 level, and then we continue rolling over. Our projected move, our A to B, was 150 points. Our B to C was 160 points. We're just 10 points off. That's it, just 10 points. So now what could we be doing? Building a little base. And the fact is, when I start looking at all these stocks, I'm watching all these Facebooks, Netflix, Teslas, I'm watching these big companies, and I'm starting to see, okay, well, what did they do? Is that the A to B, B to C, C to D? Once they hit their D move, something new can happen. We can build another B to C leg and then roll over. And or we can go sideways a little bit and consolidate, or we can just continue heading lower. Now, the healthier move is to bounce a little and then continue rolling over, or move sideways and then roll over. So when you put all of these stocks together, you can start looking at the composite the same way. You start looking at it, okay, what do I have here? A to B, B to C, and then I need a C to D. So where would that put my trades? Okay, I look at the S&P 500, A to B, B to C, C to D. Now, because many stocks have finished, they're slowly finishing their ABCD pattern. So that's why I think you might get a slight little pop here for a few days. You might not. You might get a little sideways action. We'll see. We'll see if they hover it around. But because we have the A to B, B to C, C to D, you know, right here, this on the S&P is 270 points. So taking this out to 270 points could put us to right around the 1665. So if we take this out and we look at the 1665 level, we start looking at that level, that puts us right around here. So that gives us, if we take the swing lows to the swing highs, 1665. Okay. Puts us just slightly above the 38% retracement from the long-term highs, which would not be unhealthy. It would not be unhealthy. So if we line this up, the Fibonacci levels from the swing lows of 2009 all the way to the current highs, and you do a pullback right around 1665 due to the ABCD pattern, you still be fine. If we get to 1580, you'd still be okay because you're still at 38%. Right around here, the 50% retracement is at 1413. And that, look at how these lines and numbers line right up. If we get to 38%, it put us right at the swing highs of the 2000 and the 2007. Put us right there, right at those points, and the stock market would still be just fine. So anyway, in the short-term view, it does look scary, it does look dangerous, but overall, it looks fairly healthy. The one thing that's a concern for me is that a lot of people are on the short side right now. So you do get some violent action to the upside and buyers stepping in. You get, if you take a look at the McClellan oscillator and you start looking at it here on the let's say 2-day or weekly, we're almost at a neutral state. We're almost getting into oversold area, but you're not even that far oversold. So we could actually see more selling coming in, and the market's weak. And once it starts breaking, and once you start seeing it being this week, and you start looking at the IWM, and you start looking at all these different things, IWM on the weekly, you start seeing it right here. This is breaking, clear break, okay, to the downside. Once you see the QQQs, the same thing. When you start looking at these Qs, right here, we look at the Qs at the 100 level, we're breaking. Again, crystal clear that we're breaking in these patterns, and we're doing it on volume. As we look at the volume, we're doing it on volume. So these things usually take time to digest. How long of a time? I don't know. It could be 2-3 months at least, 6 to 8 weeks minimum. But because bearish markets are shorter because there's fear, there's emotions. If we trade about 6 months worth of bearish markets, then that's probably, I would say, decent and realistic. I don't think all of a sudden do things change right away and very quickly from feeling really, really bad and crummy, and then all of a sudden change right away to fantastic. If you had an argument with your best friend and there was a serious issue, does that argument flip on a dime right away? Typically, no. Those wounds take time to heal. And the same thing here. There's going to be some people that are going to be really scared to even get back into the markets because they're losing big time. They're losing a lot of money. Some of the people that are looking and doing more active trading and so forth. So there's going to be some people scared to get back into the markets. And so what you want to do is just look at all these different indices between this composite, what you're watching, between the Russell. You see that they're all really breaking lower, and I talked about the nastiness of the market coming in, and I think now we really saw it right now. Is there more to come? The question comes down to shall we or will we get a slight consolidation and pop, in which case we may get a temporary pop. But the energy, if I look at the monthly, and this is one of the good ways to really look at things. If you just look at the monthly chart, it allows you to simply look at colors. It allows you to just look at the colors of the market. And as I extend it, it allows you to see things at a more extreme level. And on the monthly, you can see that we are clearly in bearish territory. So we're leaning more to the downside. You can see that the colors are red. And you do the same thing with the Qs, QQQs. You can do the same thing with the spiders. You can do the same thing with the IWM. I mean, it's clearly, the sentiment is to the downside. Even if you get a slight pop, I mean, the bears are in control, meaning trades to the short side are more favored. And that's really where I'm set up and positioned as well. And you may get some people that take these stocks higher and take these indices higher, and you get stopped out because you'll get violent pops. But being patient is something that takes time to learn. And when you're not patient, these are the things that can whip you around and give you a lot of trouble. So sometimes it's just best to sit on your hands. And if you can learn to sit on your hands, these volatile markets are not a big deal. They just simply allow you to buy things at lower prices. So imagine if you're able to get back in right around this 780 level, right here where the market 780, 790 level, market comes back there, and then you get another 2 to 5 years worth of gains, for an extreme amount, because that's typically what happens is after a major sell-off, you get 1 year or so, just like over here in 2002 to 2003, you get sideways action, and the same thing here in 2009 to 2010. There's kind of a sideways action a little bit right in the middle of 2008, 9 to mid 2009 and early 2010. You get some sideways action, and then you see the market take off. So the same thing here. If we get a pullback to, even if we get it to 1575, if you get half a year of sideways action after that, then you see the markets again take off. Then it's a perfect opportunity to get in. It only allows you, these sell-offs only allow you to get things at a cheaper and lower price. So you might get 3 or 4 months, maybe 6 months more of selling. It could be a full year of selling. It really just depends. Depends how bearish things get. But then you might see, about a year or a year and a half, could be 6 months worth of digestion. And then things, again, could be at a good value. So that's just natural. It's a rubber band. When it gets too far stretched, it comes back. It gets too far stretched, it comes back. And then it powers higher. So trading in these volatile markets, if you're trading, some tips, make sure you're trading lighter shares. Make sure you also be more patient on the bigger term picture that you're holding it for. If you're holding it for, let's say, a month, then know the bigger picture for a monthly move. What do you expect in the next month? And don't get caught up in this seesaw action, because what's going to happen is it's going to whip you around. So that's one of the reasons why you would want to trade less shares. If you're not good at shorting or reversing your positions or being in and out quickly, or you're not great with your computer software trading platform, you probably want to sit on the sidelines, because these are faster moving markets. And if you can't handle volatility, like on Amazon here, what happened was basically, I was watching it today. You can see right here we had a drop from the highs of about $8, and then from those highs later on in the day we had a pop of about 16 points. So this volatile market can really burn you and burn your account, and it can really hurt you emotionally. And the same thing with the S&P. Today what we did was we had a drop of 37 points on the S&P and a pop of 28 points later on in the day. If you look at the Dow Jones, which I don't really check too often, but it's the same concept. You had a drop of almost 400 points and then a pop of 221 points. So the seesaw action is something to be mindful of. But what you do want to do is you want to check the end of the day action. So you're watching, you're seeing this pop, and this is just due to the news, and it sucks a lot of people in, unfortunately, this 2 to 3 p.m. area that popped it. So could stocks continue higher and get in? We are slightly oversold, so yeah, of course they can continue higher a little bit. But at the end of the day, there's still more selling that came in. This part continued to roll over slightly. So I would say if you're trading volatile markets, just trade lighter. Be mindful. Wait until the volatility is over if you're not trading, which you'll see those things happening and moving sideways. Once you see things not moving so much day by day, then it's time to kind of step back in. But a lot of this has to do with just all the events and activities happening in the markets. Between the technicals were set up and poised from the Dow Jones to the S&P. The technicals were there, set up, ready for it to roll over. Between the yen, between the Janet Yellen things that are going on with the conversations. And the Fed, they're not going to make quick decisions and rash decisions. They don't want to stir up things. So all this questioning, I know they drill her really hard, but a lot of it is, what else can she say? What else can she really tell you? She says, well, we're going to evaluate things and we'll see how things move, and if things are get really wild or really crazy, then we'll make adjustments. But we're going to just try to do our best for the job in the best way that we can do it. So what more is there to really say about those press conferences? To me, a lot of it is just, it's just air. There's not much to them, and then people wonder, oh, she said this word or she said that word, and don't read into it too much. It's just watch how the market reacts, rather than worrying about what exactly is being said. In fact, it's better to just turn those things off. Go and read a good book and then come back once it's over, and then make your adjustments to your positions if necessary. Because sometimes, just like when she spoke the other day, here's what was interesting is that at the other day was what do we have? Wednesday, 2/10, February 10th, 2016. So at first she was speaking, and let me just use the S&P on this. So before she was speaking, there was a little bit of a lighter move. So we basically had a 30-point move in the S&P. And then we had a slight sell-off to about from here to here. We had only an 8-point positive, and then we slowly started to get back to even, and things started to roll back over. And we ended the day, I think, 1 or 2 points down or up on the S&P, and the Dow Jones on that day ended about 60 points. 70 points down on that previous day. So it wasn't that huge. So with these press conferences, a lot of them are, they're very fluffy, filled with air. And there's not much substance, because what else can you expect them to really say? I mean, she's trying to do her job. She's trying to do the best that she can. And she's not going to say anything rash one way or the other, because it can disturb the markets. And they don't know exactly what they're going to do until they need to do it. I mean, they have plans in place to do one thing or another, but it's they'll course correct, and it's tough to make a course correction with a big ship very quickly. So all they can really do is just span or stretch that interest rate time frame. They can condense it, speed it up, or stretch it out. But to turn a Titanic, it's very difficult. So there's no way that they're going to say, "Oh yeah, tomorrow we're raising rates," and then the next day after that we're raising rates as well. So as far as your own positions, take your profits into strength. Always watch when the market is coming into these critical lines of support, like the S&P here. And then look at the energy, the way that it's moving. I mean, the market here is making fresh 2-year lows, and typically that just tells you things are breaking. And sometimes these windows take time to break. Sometimes the floor takes time to break. So I would say that we probably have not seen the end of this yet, but I think we may get a bounce here or there, which would not surprise me, because we just had so much selling and so many people short. So hopefully this gives you some insight to the markets, to how they've been moving, behaving, and so on. As for me, I'm trying to pre-film a lot of videos here for the next month or two. Typically what I like to do is pre-film videos in advance, so that way I don't have to do them. And once I get more of that done, I already have about 12 hours of the option course complete. So about 12 of it is done, and I'd say that's only about 30% of it. So I'm estimating it to be about 30 hours long. So I continue to make that course, but right now, just due to trading with the markets the way they are, I'm having to focus a little more on that. But I am still working on the options course, and I do have a good amount of footage filmed, done, complete. Just have to film probably about another 20 or 30 more modules, and then it'll be off to manufacturing and all that good stuff. So, but other than that, just continue trading them well. Continue to watch and study and learn the markets. If you're not trading, just continue to educate yourself, because these times are not one-time events. They're going to happen sometime in the future. The banks, of course, are moving fairly low in sell-off, and if you're watching to get the banks at a lower rate, Bank of America, for example, watch for that $6.70 mark, or even the $5 mark. These things are selling off the highs, and they move slow. I think we posted this in the critical charts before, watching this line of support at right around the $15 level. And you can see also on these daily charts, here's the A to B, B to C, C to D pattern, which should take it right around, if we do it, let's see, this A to B is 450. And here we take it right around 450. Should take it right around $9. So, but we got so much volume coming in that, bringing it back to right around this level of $10 would not be unheard of. Same thing with these JP Morgans and everything else that goes along with it. They're acting weak, and once the banks roll over, and you got the same thing happening with a lot of other stocks, it just pulls and sucks everything in as well. So it's just a ripple effect. Think of it like a hurricane. It's sucking everything in, and that's what happens. So enjoy the rest of your week. Enjoy the weekend. Make the most of it. I hope you have a great time in whatever it is that you're doing. For me, probably planning out more videos for you guys, working on the course, and just continue to work on the options course. It's a monster, so it's going to take me a little bit of time, but still working on it step by step. Anyways, see you next week. Trade them well.